Welcome to Inside the Deal. I'm Suzanne Stevens. With me today is Bob Profusek. Bob is head of global M&A for Jones Day. Bob, we had nearly 1,200 announced deals that didn't go through in 2008. Deal volume was off by about 50% in the fourth quarter. Yet in a column coming up in the Deal, you say there's reason for optimism about the M&A market in 2009. Why so?
Well, probably for the very reasons that things went down in 2008. First of all, historically, during a break period in the market, there's a very rapid, usually, and very dramatic return to high levels of activity. The one thing that makes this period different is the absence of credit. Bank credit is practically speaking unavailable. Bond markets have woken up a little bit, but it's way too early to call that a recovery, I think. However, that very fact is probably what's going to propel a lot of deal making going forward, both for strategics and private equity, namely targets needing to refinance their debt, cover their put obligations on convertible debt, all sorts of things like that. So I think that we can expect probably in the next 6 months, a lot of deals to be done on a really sort of a shotgun wedding basis, where people have to either deal or consider much more draconian consequences.
And so these are targets that are distressed simply because they can't refinance their debt. So the underlying business is still strong, which really makes them even more attractive.
Yeah, I agree with that. There are two categories: companies that are getting absolutely bombarded by the current market conditions, retailers, people in the auto space, all that sort of stuff. They're distressed. Their businesses are distressed. And so there'll be a lot of combination and a lot of private equity money coming into those businesses anyway. But what I'm talking about are companies that are hurting a little bit. Everybody's business is down some. But businesses that are good businesses, not headline industries in terms of distress, but have to do something about their balance sheets. And in this environment, that's very difficult to do. Now, a lot of them will not necessarily be taken over. They'll bring in private equity money. They'll do pipe kinds of things with investors like Warren Buffett and that sort of stuff, but a lot of them will be acquired.
Let's talk about when deals do move forward, pricing. M&A pricing, where did it end in 2008? You know, how down was it? And how challenging is it for companies to conduct valuation in this market?
Well, when there's been such a dramatic shift in the overall equity valuations, it makes valuation concepts difficult. When investment bankers advise boards, they traditionally look at comparable transactions or comparable companies. Well, what's comparable, before Lehman or after Lehman? You know, it's very difficult to figure out. On the other hand, it's pretty clear that there's been a dramatic change in valuation in the equity markets in general. And in the M&A market, it's been really about the same. Multiples at the end for the fourth quarter of 2007, multiple of basically cash flow, were about 12.5. And for the fourth quarter of 2008, they were down to 8.5, 8.4. So that tells you two things, not surprisingly. All valuations have come down as the S&P 500 has come down, everything else. It also tells you that from a buyer's standpoint, things are marked down as sort of day after Christmas pricing for private equity and, frankly, for the strategics that have big balance sheets and can be doing a lot of shopping these days.
Before we see private equity really come back into the market, I mean, they've been out raising capital and raising a lot of capital, certainly over the last year. When do you think the credit markets are going to loosen up? When will banks start lending?
Well, I'm probably no more qualified.
What's your best guess, I should say?
When housing prices stabilize. And when's that going to be? And it'll probably be in different times in different areas of the country and around the world. But until housing prices stabilize, you know, people in Washington can jawbone all they want, but banks are going to hold on to their capital. I mean, it's been a big week for announcement of bank earnings, and they've been pretty shockingly negative. Having said that, alternative sources of capital, the one thing that is really wonderful about the capital markets is they find a way. There's always going to be capital. I think you're going to see a lot of seller financing coming up, whether from corporates, whether that's on the buy or the sell side. I think we'll go back to the days where private equity transactions are done, and part of what shareholders get, whether public or private, in the target company might be debt in addition to cash. there are other ways to finance things. We tend to be, as the deal community tends to look back at where it's been and kind of feel bad about that it's not there anymore. But what we really should be realizing is that the capital markets change every day. This has been a radical change, but there'll be different ways to do things. And I think seller financing will be a big part of the program going forward. There's no reason necessarily that a shareholder couldn't take some debt and some cash.
Well, buyers are already using a lot of these alternative deal structures.
That's right. And some of those for distressed assets will be done through Chapter 11. Some won't. And there's going to be just a much more of a cornucopia, smorgasbord, whatever metaphor you want to use, of different kinds of ways of going about things.
Bob Profusek with Jones Day. Thanks for coming in.
You're very welcome.
I'm Suzanne Stevens. Thanks for watching Inside the Deal.